In Walmart's Who Newville, joy started to grow. For online-only savings sure to steal the show. Tech treats and toys so dazzling and new. Walmart Cyber Monday deal soon ready for you. It's online only with very little time to spare. December 1st will soon be here, so be sure to be there. The Who's are prepared. Are you ready too? A day packed with savings. Amazing! Who knew? Subject to availability, terms and fees apply.
Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
On today's episode, I'm going to keep talking about DCFs and valuation, how we do it in value investing. But today, I'm not going to go about how we are inputting all of the numbers, which was related to the forecast we did. We already covered that in my previous episodes. What I want to do today is tell you the 8 common pitfalls that appear in all of the DCF models so you can avoid the traps. Because I'm sure that you've noticed a trend already in all of my value investing episodes. We are not reinventing the wheel from finance things. What we're doing is just being a little bit more cautious for every step. So we started bringing this new ratio that was ROIC, but we were very careful and cautious when we were calculating it. We also were doing the free cash flow of the firm and DCF, but we were more careful when we were doing it. So now, whenever you are going to do your DCF, I want you to also keep avoiding the traps, because the traps are going to be where all of the normal investors are falling, and that's why they make their decisions. As a value investor or as an intelligent investor, Graham would say, you have to avoid all of these tiny traps. So, the first trap is going to be a forecast horizon that is too short. And I already touched on this on my ROIC episode, but one of the most common criticisms of the DCF models is that the forecast beyond a couple of years are going to be suspicious. And all of the critics are going to argue, well, who can really predict a company 10 years from now? However, this reasoning is fundamentally flawed because if you think about it, asset prices today inherently reflect expectations about a company's long-term cash flow, often many years, even decades into the future. So a stock that's trading at 20 times earnings, it's implicitly relying on a long stream of future value creation. So what I'm saying in simple English is we are already having these assumptions. The fact that we're not having them carefully means that they are flawed. So the real danger of a short forecast period, let's say only 3 years or maybe even 5 years, is that it will force whoever is modeling it on relying heavily on the terminal value. And this is the single massive number that's supposed to capture all the value beyond your explicit forecast period. When the explicit forecast is too short, this terminal value often becomes disproportionately large, sometimes accounting for 80 to 90% of the total calculated intrinsic value, leading to a completely non-economic continuing value that's incredibly sensitive to tiny changes in the assumptions. So the best practice here is going to explicit forecast periods to not less than 5 years. And for many companies, especially those with strong competitive advantages or long growth runways, you might even need to forecast like 10 years to truly justify their stock prices or to capture their value creation potential. Ideally, your explicit forecast period should also capture at least 1/3 of the corporate value with clear, well-supported assumptions. So analysts should aim to forecast cash flows explicitly until a firm will reach a steady state. And over there, its cash flow growth, it's going to become more stable and constant, and its returns on new investment should normalize. Pitfall number 2 is going to be on economic continuing value, which means issues with the terminal value. So building up on my previous point, the continuing value component is going to capture the firm's value beyond the explicit forecast period, potentially even into perpetuity. And this is perhaps the most critical assumption in many DCF models and a major source of error because many people aren't thinking of this number. A crucial economic lesson that I've emphasized throughout all of these episodes is that competitive forces will ensure that returns on investment will approximate the cost of capital over time. And this is the mean reversion. A sound DCF structure should explicitly capture a company's excess return on new investment during the explicit forecast period. Then, continuing value should reflect the company's value after its incremental value creation opportunities are exhausted and all of the returns have normalized. So a common mistake is simply applying a multiple, like an EBITDA multiple or a PE multiple, to the ending period EBITDA or earnings in order to estimate this terminal value. In this method, we'll rarely have a solid economic foundation and can implicitly imply unrealistic future financial performance. So the best practice here is that the more robust approach for continuing uses a perpetuity assumption based on the company's stable long-term cash flow. And this approach will naturally capture the mean reversion by assuming that beyond the explicit forecast period, incremental returns on new investments will approximate the cost of capital. This does not rule out growth in perpetuity. A company can still grow its cash flows at a nominal rate, so let's say inflation, but it implies that this growth beyond the explicit forecast period is assumed not to create additional shareholder value above its cost of capital. And even better, we can leverage an ROIC fade approach for the terminal value. In this one, a company's ROIC will gradually decline from its peak or current level towards a weighted average cost of capital, which is the WACC, over a reasonable fade period, let's say 5 to 10 years, depending on the mode. This method is going to allow for approximating the terminal growth rate based on a realistic capital efficiency assumption without implying indefinite economic profits. And this will be way more economically sound and defensible in order to calculate the terminal value. Pitfall number 3 is going to be around the WACC, because estimating the discount rate, often referred to as the WACC, is notoriously difficult. And in my previous finance episodes, I've spoken a lot about how we estimate this number, but it is generally not where the investors will gain a significant analytical edge. Trying to pinpoint the perfect WACC is often a fool's errand, but understanding the components and the common errors is going to be crucial. While the cost of debt is going to be often relatively transparent because you can look at interest rates, the cost of equity is going to be the one that's unobservable, and it will rely on the CAPM, which I've already talked about, but it has some important parts. So the beta, which is an input in CAPM, theoretically measures the stock's volatility relative to the overall market. However, beta will often fail to practically and empirically explain actual stock returns. Moreover, if we're trying to estimate a forward-looking beta reliably, is going to be very, very challenging. An historical beta can be very noisy and may not reflect future risks, so this is a practical limitation. Another practical limitation is going to be the equity risk premium. This number, I usually avoided it in my previous episodes because even my professors were like, just use a number between 4 and 6%. But this is going to be the expected return of the market above the risk-free rate. And ideally, the ERP should also be forward-looking, but we don't usually do that. We rely on past historical averages, and this may be misleading because ERP is not static. It's going to be dynamic and will change significantly over time. So, what is the best practice here? When estimating WACC, always consider using market values for debt and equity for their relative weighting, not just book values. and ensure that the time horizon for your cost of capital is consistent with your cash flow forecast. So think about the term structure of interest rates, which means how interest rates vary from different maturities, and also the long-term mean reverting nature of these financial variables. So rather than just relying on a single short-term point, you should focus on these other things. And importantly, again, also perform sensitivity analysis. This is key in your WACC assumptions, and even small changes might have an important impact. So, if you're doing your DCF, just add a lot of sensitivity on your WACC, and this is going to help you prevent mistakes. Pitfall number 4 is going to be the mismatch between assumed investment and earnings growth. And this is a fundamental economic truth that often is overlooked in DCF companies because companies must invest to grow. And I laugh a little bit because when I'm saying this phrase, I'm hearing Adam Newman on the Apple series saying, Rivka, we must invest to grow. Well, it is technically true. Companies must invest to grow. You shouldn't grow like we work, but you can't have revenue grow or even just maintaining existing revenues without capital expenditure and working capital investment. DCF models will frequently underestimate the investment that's needed to support an assumed growth rate, and this error often stems from analysts projecting revenue growth and profitability margins independently without adequately linking them to the capital required to achieve that growth. I already told you to watch out for this when you were forecasting, but as a best practice, you should include an ROIC line in your model as a crucial check. If your projected ROICs suddenly rise or drop sharply without a thoughtful strategic basis, your model is likely unreliable. And furthermore, also restating free cash flow to the firm as a function of its key value drivers. So in the new formula that is ROIC and the reinvestment rate can help you ensure internal consistency. So this is going to be how you solve for pitfall number 4. Pitfall number 5 is going to be the improper reflection of other liabilities, because many DCF models, particularly the simpler ones, do a very poor job on reflecting certain liabilities economically soundly. So liabilities like employee stock options are very tricky to capture. And if not treated correctly, they can lead to an overstatement of the equity value. Similarly, pension liabilities, operating lease obligations, all of those need to be properly accounted. So as a best practice, you should ensure to understand all the claims in your business, not just traditional debt and equity, and adjust the cash flows of your discount rate in order to make a separate deduction from your calculated enterprise value in order to correctly amount for these additional liabilities that will impact the value. Pitfall number 6 is going to be discounting to private market value. And this practice can be quite problematic because some DCF models apply an arbitrary public market discount, so let's say like 20-25%, to the calculated standalone intrinsic value. And this practice lacks transparency and it conflates the standalone business with potential synergies. So, as a best practice, your DCF model should always calculate the intrinsic value of the standalone business. But this is how I taught it in my podcast, so if you're following my podcast, you're all good with this one. Pitfall number 7 is double counting. And this might seem obvious, but it's a common error that models should avoid counting a dollar of value or liability more than once. But double counting can appear a lot. So, for example, building share repurchases into models by assuming that a shrinking number of shares outstanding for EPS calculation while also valuing the cash flow that funds those share buybacks with the free cash flow of the firm. So share repurchases, make sure that you're not double counting them. Also, interest income from excess cash balances on your cash flow projections shouldn't be counted. So trace your cash flows and value components carefully to ensure that each component of the value is counted exactly once and only attributed to the correct part of the valuation. And lastly, the pitfall number 8 is going to be the different scenarios, because investing, as I've been telling you throughout my episodes, is inherently probabilistic. We are making predictions about an uncertain future, Yet, many DCF analysis offer only one scenario, which is very flawed, because they're often based on a shaky or optimistic assumption. So, this is very false prediction. Sensitivity analysis is very used, but it doesn't also consider how interactions between the value drivers change. So, the best practice to minimize errors and to incorporate an extra scenario where you can forecast the uncertainty, you should estimate ranges of possible outcomes. And this can be done by using multiple scenarios. So let's say a base case, a bull case, and a bear case. Even Monte Carlo simulations for very complex models would be useful, but crucially, what you want to do is have a bad scenario, medium scenario, and good scenario. And then on top of those, you could do sensitivity analysis if you want. But it's not only about changing one rate, it's about the entire thing. So I want you to take away all of these pitfalls in order to avoid them, because again, these tiny mistakes are what will separate normal investors from value investors. The process that you're doing is exactly the same. You're both calculating DCF models, but if you avoid the mistakes, you will become the value investor. So I hope this was useful. Let me know in the comments if you liked it. And also give me a review if you did, because this helps me tremendously to reach more people globally with my podcast. Share this episode with a friend who also wants to learn about MBA things or about value investing. And I'll see you next week to talk about the art of reverse.
The holidays mean more travel, more shopping, more time online, and more personal info in more places that could expose you more to identity theft. But LifeLock monitors millions of data points per second. If your identity is stolen, our US-based restoration specialists will fix it, guaranteed, or your money back. Don't face drained accounts, fraudulent loans, or financial losses alone. Get more holiday fun and less holiday worry with LifeLock. Save up to 40% your first year. Visit lifelock.com/podcast. Terms apply.
DCFs.